and I'm joined by our Director of Financial Planning and Wealth Advisor, Dan Staus. If you're unfamiliar with Flagstone, we are a fee-only comprehensive financial planning firm. One of our top values is education, and we seek to continually be a resource for solid financial education outside of our regular meetings with clients. Today, we'll discuss life insurance, and then we'll take questions toward the end. If you have a question we don't get to, we'll follow up with you individually, but you're always welcome to contact us afterward as well. We welcome all financial questions. To submit one anytime during the discussion, click the Q&A button on your Zoom controls and type in your question. You should see an option for it to go to everyone or only the panelists. Please choose panelists only. Flagstone is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Past performance is not indicative of future performance. Should we get started, Dan?
Yeah, let's do it.
Let's do it.
Yeah, thanks for that disclaimer too. It's always fun. It's a mouthful, but it's important. One of the things I kind of want to add to that is that we here at Flagstone, we're a fee-only investment firm, meaning we don't sell anything that has commissions. I mean, really, we're not selling anything aside from our advice. So what that means, we can't actually sell insurance products because the vast majority of insurance products have commissions built into them. So the topic today is going to be insurance, and we have some experience and education with insurance with our CFP credentials. I'm a CFP, Mike's a CFP. Mike used to be licensed to sell insurance in the state of Nebraska years ago. So just keep in mind, this is coming from the perspective of professionals who are trying to give a transparent picture of what insurance characteristics look like, what insurance need might be, without actually getting compensated for opening a policy for somebody. So if someone ever did want a policy, like in their client or even a prospect, then we're connecting those people with other insurance professionals. So I just wanted to mention that too, so you can kind of have that perspective. So yeah, life insurance is not a super thrilling topic, but it's a really common topic that we discuss with our clients because it's a really big, important part of a financial picture. I mean, when you think about the steps to financial independence, usually it's, step number one, be able to pay the bills. Step number two is usually ensure what the assets you have. And so it's kind of early in the process of someone's financial journey. So it's an important thing to keep in mind. Life insurance, I'm going to talk about two questions related to that today. First question, how much do I need? Second question is kind of the age-old question of which is better, term or whole life. Two basic questions. So first question, how much do I need? And there's actually a blog article that I wrote about this a while back. Amy can put the link to that article in the chat so that if you're watching, you can see that. And on the recording, we'll put it in the notes, the description of the video. But there's kind of three ways to think about how much insurance you might need. The first common one that people hear about is called a income multiplier method. And you'll just hear insurance agents say, oh, you should have 5 times your salary or 10 times your salary or 20 times your salary in insurance. So let's say you make $100,000 and you follow the income multiplier method and you're going to get 5 times your salary. Well, it's just $500,000 of life insurance then. And that's as simple as it gets. Different multipliers are used for different reasons and for different scenarios. So if you are a key person in a business, there might be a different multiplier that is used. If you are 45 versus 25, then there might be different multipliers that are used. The purpose of life insurance at its core, for the most part, is to ensure future income. Well, if you're 45 years old and you're going to retire at 60, then you've got 15 years of income to insure. But if you're 25, you've got 35 years of income to insure. So those income multipliers might be different for those two different people. The problem with the income multipliers is kind of too simple. It doesn't take into consideration anything else. Like, what if you inherited $2 million from a parent who passed away early, and you're 35 years old? Well, do you really need a ton of life insurance? Probably not. If that inheritance can hold you over, if you had an event where you passed away and that inheritance money could go to your survivors, but you might. I mean, what if, in that same scenario, if you spend $200,000 a year, then you probably do need some life insurance. So there's a lot of other factors to think about, which is the downside of that method. Second method to determining how much life insurance someone needs is called the human life value. It's kind of I don't know, it's almost a disturbing term for it. And I think, like, you're basically assigning a dollar value to the worth of someone's life, but that's what it is. It's saying, okay, how much income is this person going to bring in the rest of their lives? And, we have to account for some sort of rate of return or discount rate when we think about that. How much are they going to spend the rest of their lives? And then you kind of net those two amounts out, and you say, like, this person is worth blah, whether that's 200,000 or $2 million. And then that's how much you get in life insurance then. That's like a really complex method, actually, because there's a ton of calculation involved. And so it's not simple to do on your own. There's some financial planners who really rely on that method. The good thing about that is that it kind of makes whole someone's financial life if they were to pass away. And what I mean by make whole, I mean, at the end of the lives of your survivors, theoretically, they would have the same amount if you passed away compared to if you lived. The other thing to note about, like, make whole purely from a financial standpoint, obviously, but that's the good thing about human life value. The downside is, again, it doesn't consider how much money you already have. So you might have a human life value of $500,000, which would indicate you need $500,000 of insurance, but maybe you barely spend anything, and you've already saved $1 million in assets. So if you were to pass away, your survivors would be fine. That's the downside. That's similar to the income multiplier method, but it is a little more thoughtful than the income multiplier method. And the final method is needs-based. Basically, what that does is it starts with your financial goals. What do you want to do between now and the time you pass away? And how much are those things going to cost? And if you died today and your survivors didn't have your income anymore, would they be able to do those things or not? And if they couldn't afford to do those things because you died, then how much insurance would we need to be able to do those things still? And so that's really like a goal-based, a needs-based approach. And that's usually the approach that we use here at Flagstone. When you do comprehensive financial planning, a lot of your discussions around goals. What do you want to do with your money? And so if a lot of times we'll take that perspective of, okay, if you can't accomplish those goals, then what would the insurance be for? There might be scenarios where you still want insurance and where it still makes sense, but from a death benefit standpoint, from a goal standpoint, sometimes those goals aren't at risk. But a lot of times, especially for younger folks, it is. And so a lot of times we are connecting our clients with insurance advisors and insurance agents to get them some insurance if they don't have any. So that's the first question. I'll be really brief with my second one. As brief as I can be about whole life versus term. Amy, if you could share that graph that we created. This is a little thing I did about 3 years ago, which is crazy to think that it's been that long, but I actually got quotes from an insurance agency about comparing some whole life and term options. The whole life, it has a death benefit and it also has a savings component. Term life insurance is basically it's just the death benefit. So when you look at which is better, whole life or term, and you just look at what they do, whole life looks better. Like there's no question. You have 500,000 of death benefit versus 500,000 of death benefit plus some savings. Well, I like that more, right? Well, it's kind of like comparing a Tesla to a Chevy Spark. Well, of course the Tesla's better, but it also costs a ton more. So you have to consider the cost. And so what I did with this chart is I compared, okay, the quote I got for a $500,000 whole life policy was on a 35-year-old male, and it was going to cost $7,000 annually. And so then I got a quote for $500,000 of term, which ended in 30 years. So that male would turn 65 and then that policy would go away. So I took the cost of that policy and said, well, if they had that term policy, instead of the $7,000 a year whole life insurance policy, how much money would be left over to save in something else? Because that's really what you need to look at. If you're willing to spend $7,000 a year on whole life insurance, the question is, well, could you do something better with that $7,000 a year? So that's what this chart compares. The blue line on the bottom is the guaranteed growth of a whole life policy. And that's just this particular policy that I was quoted. This isn't every policy, but this particular policy had a guaranteed growth rate. And so it showed what would happen to that cash value over time if you paid that annual premium. And you end up, by the time the person is 90 years old, they have a little more than $500,000 in cash value. The whole life policies also have this non-guaranteed growth rate, and it's basically saying like, yeah, we guarantee this, but that's like the minimum. We usually get more than that within savings component of our insurance products. You'll hear that from insurance agents. And so I said, okay, what if you did get that non-guaranteed number? Well, it's a little closer to 1.1, 1.2 million. The gray line on the top is what if you just got the $500,000 term insurance policy, pay that until you're 65 and then you're done with it, because hopefully you've saved enough in retirement so you don't need insurance anymore by the time you're 65. And then with that money left over, because the term policy was so cheap, so much cheaper, what if you invested that in an investment account that earned, my projected rate of return on here was like 6.5 or 6.8, something like that. Before retirement, and then after retirement, the return, I dropped it to like 5.25 or 5.5, which is meant to show that people usually get more conservative when they retire with their investments. Those are not guaranteed rates by any means. And that's much riskier than a whole life insurance product. Okay, there's no guarantee of making any money. But over the long term, it's probable that you could have a positive investment experience here. So anyway, that shows, I'm going to move this out of the way here. The projected value in that account is closer to, 2.7 million or so. So very different values at the end of life there. Also very different risk profiles, but the point, and this is also very simplified, like it doesn't take into consideration, well, what if someone died when they were 45? Well, they also get the death benefit, so doesn't that change this a little? Well, yeah, a little bit, but they get $500,000 regardless, whether they have the term or the whole life. But it does change this to an extent. So this is oversimplified, but the point here is consider the cost of insurance when you're making insurance decisions. It's not just about, you know, which is better, because there's like a lot of bells and whistles on a lot of insurance products, but they all cost money, usually, at least. So that can't be ignored. That's it for the insurance, for like the kind of first half of this presentation. The rest of the presentation, we have some Q&A, some time for Q&A. So Amy, are there any questions that we can answer for people?
Sorry, we do have a couple questions and I'll get to those, but I also want to open up and let viewers know that you're welcome to send in any questions right now. So let's see. We had a client ask a question in advance with some things that they're working through. And the question was, does it make sense to have life insurance in retirement?
Yeah, that's a great question. You know, I'll go back to what I said earlier with, at its core, like the fundamental purpose of life insurance is typically to ensure future income, or to make sure that you can accomplish your goals, or that your survivors can accomplish their financial goals if you were to pass away. So usually when you're retired, there's not income left to insure. There may be situations though where you would still need insurance to accomplish some of those goals. And so it's kind of a case-by-case basis, but oftentimes by the time someone's retired, assuming they've done a diligent job of saving, then the need for insurance is less. Oftentimes it's not there at all. More likely there are estate planning or legacy type purposes for life insurance for retirees that make a little more sense than you know, the standard purpose of life insurance. But with that said, that's not super common. Yeah, I'm not going to get into a ton of detail. I could talk about that for 2 hours, but that's my brief answer at least.
All right. What will happen to inheritance taxes with a Biden presidency?
Yeah, that's another good question. That actually kind of relates to what I was saying in the first question about estate planning purposes for life insurance. Long story short, we're in a really favorable environment right now for inheritance tax and estate tax. The very vast majority of families will not encounter any sort of estate tax on a federal level. In Nebraska, there is a state inheritance tax. It's not very big for very close relatives. Progressively gets a little higher with more distance from the person who passed away. But from a federal level, Biden has indicated that there may be some return to the old estate tax limits. So I should say estate limits. So if your total household estate is lower than say $25 million, then there won't be an estate tax issue. I can't remember the exact limit right now. And did I say thousand or million? But it's multiple millions of dollars. Okay, I did. I can't remember the exact number off the top of my head, but it's huge. Well, Biden has indicated that they may lower it to what it used to be, which was much lower. I want to say it's less than 5 million per person. Again, I can't remember those exact numbers either, but we can put that in the description of the video too. But we might have a return to those levels. And so estate planning issues to avoid estate tax are going to become more important and more utilized. I mean, there have been a lot of complex estate planning strategies that haven't really been employed in the past like 10 years because we've been in this super low estate tax environment, but we might not for much longer. So anyway, we'll always keep an eye on how those laws change and we'll adjust our advice accordingly. But that could be become a bigger part of discussions with our clients in the future.
Yeah, that makes sense. Do you have, do you need to have insurance on children when they are born?
Yeah, so I think that speaks to the fact that insurance agents oftentimes will reach out to their clients when they have a baby and they're like, hey, we should get $10,000 or $25,000 of insurance on your newborn. And it's usually a permanent policy. It's like a whole life policy. They'll have some cash accumulation. Most people don't need that. I should say most Flagstone clients don't need that. If you couldn't afford a funeral for a child, which is terrible to think about if that ever happened, but if it did and you couldn't afford it, then life insurance might have a purpose there, and it's super cheap. That's another thing that agents will say is like, oh, this is so cheap. It's like $5 a month or less than that. But the reality is most people don't need it. It's a really unlikely occurrence that the child would pass away. Another benefit that is often discussed with that is that, oh, it'll be this kind of savings account that eventually you can transfer ownership to that child. And so when they're 25 or 30, you can put it in their name and it'll be this kind of gift that you can give to them. Well, the thing is, with those whole life insurance policies are super conservative in terms of growth. And so it's just not going to grow a ton compared to doing something else. I go back to like, if you're going to consider putting, let's say, even $20 a month into a policy like that, what are your other options on that $20 a month? What if you put it into a 529 account for the child, and then you could invest it for the long term, compounding growth over 20 years in a more balanced allocation of stocks and bonds, as opposed to super conservative like whole life insurance? That should lead to a better result. Again, it's definitely not guaranteed, but I think you'd come out ahead, be happier with that. Or if you're worried the kid isn't going to go to college, or you don't want the restrictions that come with 529 accounts, you could open an investment account that's not a 529 college account. It's just a general investment account. That's another option. But that's a really long way to answer it, but I don't think that that's usually necessary to have insurance policies on newborns or children, unless you really couldn't afford a funeral.
Okay, thanks. There's one more question, but just a reminder that if you have a question, we do have a few minutes left, so you can type it into the Q&A button toward the bottom. So this question deals with tax contributions, or with contributions, and it specifically asks, are there contributions I can still make through the April deadline that will benefit my 2020 taxes? Yeah, you can make contributions to IRAs subject to income limits. Roth IRAs have income limits. You can put $6,000 a year into those. Unless you're a little older, you can put another $1,000 in there, so for a total of $7,000. That's one option. Again, you have to have earned income. You can't have too much earned income. If you're over those limits, you can always put money in a traditional IRA. Whether you can deduct that is dependent upon your income, and you have to have earned income to do it. But that's one option. SEP IRAs and simple IRAs, you can put money in those before the year, or before tax filing. You can count towards last year. HSA contributions are another one. You can put money in there before tax filing and count it towards last year. There's restrictions on all of those. There's rules that you have. There's things that you have to meet to be eligible for that. But those are the things that come to mind. You can't put extra money in your 401k for last year. You can't put money in a 529 account for last year. Yeah, I think those are the main ones that come to mind, at least. Okay, well, that's it. There are no additional questions. Dan, thanks so much. And viewers, it's great to have you with us. Thanks for being with us, and we'll look forward to next month's office hours. Have a great day.